Good morning, traders. Welcome to the live stream. My name is Charles Gough. I come from a community called PirateTraders, where we are focused on the ES, the NQ, and how they move through the two-way auction process. I appreciate you all joining me here this morning. I asked in the chat, where do you think the market is going to go today? Jump in there and let me know. I will tell you why I'm asking that question in a second here, but I would love to hear your feedback as to which direction you think the market's going to go. Or do you think we're going to go up? Do you think we're going to go down? Do you think we're going to kind of just go sideways, go nowhere? Where do you think the market's going to go today? All right. Well, to start with, as always, let's zoom out a little bit to give ourselves some context as to, where the market is and what might happen next. So I'm going to start by zooming out and taking a look at the daily chart. Okay. The daily chart, just looking at it in regular candlesticks can often give you a very simple view of the market. And that's a good thing if you're looking at the market over a longer time frame. If we tried to look at every single piece of data, every single level where something happened over the last few weeks, our mind would not be able to understand it. It would just be too confusing. So what candlesticks do is they simplify what we're looking at to make it, much easier to sort of articulate bigger picture what's happening with the market. So just looking at my daily chart here, we can see a couple of things. Let me get my drawing tool. Okay. So first things first, we can see the market had a lot of momentum to the upside, okay, towards the second half of last month and into the beginning of this month. We had this big move. This channel right here is what we call a balance area. One way the market can balance is inside of a channel. So when we looked below that balance area low and failed, it increased the odds that the market was going to slingshot up to the opposite end of the balance, right? You can see that here as well. It got to the balance area low, didn't continue lower, slingshot back up to the opposite end of balance, okay? We then got new momentum breaking out of this balance area, which gave us another big push to the upside. So if we had failed at that balance area high, we would have likely come back down. The fact that we didn't fail meant we were going to get a move to the upside. Okay. So from that move of momentum, we have begun to balance again. Last week, we began this balance. Our new balance area is this horizontal box that you see right here, this blue box. So we think of that the same way we were thinking about the channel, okay? If it gets up above the top end of that box and it can't keep going, it's likely to head to the lower end of the box and vice versa. So for that reason, on Friday, I was saying that on a swing basis, we were most likely heading to the balance area low, which is around 62.60, okay? Well, here's where things get a little bit tricky. We got there. In the overnight, over the weekend, we got to that balance area low. Now, normally, we don't really care what the market does over the weekend. We really only focus on what happens during regular trading hours. However, with balance areas, that is the one exception. The one exception is if something happens in relation to a balance area in the overnight or over the weekend, that counts the same as if it happened in the regular trading hours. As a matter of fact, this look below and fail that told us the market was likely to slingshot up happened in the overnight. The market poked below that level and we opened like right here that day. We opened above that balance area low, above that channel low. So over the weekend, this weekend, we did that same thing. We came down to the balance area low and we just kissed it, just barely kissed it, and then turned around and started heading back up. So that makes things a little bit more complicated for us today. Okay. And by the way, I drew that balance area last week and it came down. I put the low at 62.60 and it came down to a tick exactly to 62.60. Okay. So that's not me saying I'm Nostradamus, but me clarifying that I didn't draw these lines after the fact. I drew these last week when we were up here saying that we were heading down to 62.60. Okay. So now that we got there, what comes next? Well, unfortunately, that basically means anything can happen today. The market could go up because we could start that slingshot effect, sending us right back up towards those all-time highs. We could take another poke at those lows, trying to break out of balance to the downside, or we could spend a day basically going nowhere and just chopping around. All three are about equal probabilities today. So because of that, we have to be like water. There's a famous quote from Bruce Lee where he says, be like water. If you pour water into a cup, it becomes the cup. If you pour water into a teapot, it becomes the teapot. So throughout the day today, whether we are going to be trading balance because we think the market is going to go sideways, or we're going to be trading momentum up because we think the market is going to go higher, or we're going to be trading momentum down because we think the market is going to go lower, we have to be ready to change our minds very, very quickly. Okay. We have to be ready to say, you know what? It looked like balance, but now we're getting support. So this thing is going to break higher. Or it looked like it was going to break higher, but now that support just broke. So we're going to head back down to this lower level. The market is in balance. We have to be ready to change our minds very, very quickly, because what the market loves to do when it is inside a balance area like this is behave in incredibly hard ways to read. It loves to make it look like it's about to go way higher and then completely reverse. Make it look like it's going to crash and burn lower and then completely reverse. It loves to play this game when it's inside of balance, because the market is just a machine to create liquidity. That's all it is. Price just moves up and down however it needs to move in order to get the most contracts to trade hands. If we are in a moment where, bigger picture, people aren't that bullish, we're at all-time highs, but there's a lot going wrong in the world. There's a lot of uncertainty coming out of the White House. There's so much that would make people afraid to go long because we're at all-time highs. And there's a lot of people who are worried that the market needs a pullback, that it's gotten overextended. Then it's just a great moment for the market to go sideways and chop and grind up and down, maybe for weeks, right? Because it can keep getting people that are afraid they're going to miss the long. It can keep getting people that feel like they need to be short, and then squeezing them by just reversing out of nowhere again and again. So this morning, we want to be like water, my friends. We want to be ready to change our minds and focus on whatever the market is telling us in that particular moment. So how do I see the way to trade today? Well, we still got 20 minutes till the market opens. Depending on where we open, the first thing to think about will be a gap. So if we open with a gap down, meaning we open below Friday's low at 62.78, it means the first order of business will be trying to fill the gap. If we have a gap down, there is a high probability of a gap fill today because we're in balance. Okay. And gaps get filled much more often when the market is in balance. So a gap fill would be the first priority, and then what happens at yesterday's low. If we open where we are right now, inside yesterday's range, I would basically see the area from yesterday's low, from 62.78 to the current overnight high at 62.86 as a chop zone, meaning there's really no edge. There's no way to know which way it's going to break, but getting above or below one of those levels would line us up for whatever the next move is going to be. So if the market were to open and get above that overnight high, which is currently 62.86, and it were to find support up there and it were to bring in new buyers, that would be bullish to me. It would be bullish because we already tested the balance area low, meaning that if we get new buying above the overnight high this morning, and we're using 62.86 as that level, we could include Friday's range as well, but we just won't. So we're using 86 as the level currently. Again, still have, 20 minutes till the market opens, so they may poke up there and change it. But for now, if we see new buying above that overnight high, then we assume the market is getting that slingshot move that we talked about on the daily time frame, right? If we get to that balance area low and we can't go lower, the higher probability is that we're heading back up. So seeing new buying during the regular trading hours today above that overnight high is telling us we have momentum up. If we have momentum up, it means we can trust that the market is still in balance, that we're moving from one end of balance to the other. So we want to get bullish quick if we get that new buying above the overnight high. We don't want to wait around to enter trades, because with momentum, the sooner you can enter the trade, the better off it is. The longer you wait to enter a long, if we start to get momentum to the upside today, the worse and worse the odds are with each move up. You want to get in early and then ride that wave as far as it can go, which could go easily as far as these weak references that we left behind from Friday, 63.10. Okay. So if we get new buying above 62.86, get bullish, get in a trade as soon as you can, targeting moves towards 63.10. If the market gets above that overnight high and it can't bring in those new buyers and it starts to pull back in, we're back in a chop zone. And we're waiting to see what happens at Friday's low. If we get below Friday's low, we look for resistance there the same way we're looking for support at the overnight high. If we get resistance at Friday's low, it is a little bit bearish. It is not super bearish. It is not like the same as being bullish at the high. Bullish at the high means we're getting the slingshot move. So that means we're combining a swing trading signal, which is the balance area, with an intraday signal, which is buying above the overnight high. That's a reason to get very bullish very fast. Okay. But resistance at Friday's low might just mean we're going to spend some time grinding around Friday's low. It doesn't necessarily mean we have to come back for that balance area low. So you can get short, but you want to make sure you're moving your stops below your entries as soon as you can, and you're taking profits quickly and you're not falling in love with that trade. I see a lot of support in the overnight range over the weekend, right here around 62.71. Okay. So new selling below the previous day's low might just get us to 71, and then we bounce up and out of there. New selling below 71 is bearish, and it increases the odds we're heading back down for 62.60, which is that balance area low. Now, we left behind these weak references last week. Okay. 62.64 and 62.62 are weak references. So those are a strong magnet pulling on price. Though that is not a stronger magnet than the balance area, which we bounced off and we started our move up. So we don't need to worry about these weak references if the market opens and it gets momentum to the upside. Okay. But if it doesn't, if it opens and it gets resistance at Friday's low, those are a magnet for the market to come down and repair. Okay. So we'd be cautious in the first bite of it from the overnight low to this support. We'd be cautious because they may just bounce there. But if they don't bounce, if we get that new selling, we want to be like water and we want to recognize this momentum is heading down to 62.60 to repair these weak references, to test the overnight low, and to test that larger balance area low. Okay. New selling below 62.60, which to me doesn't seem that likely today. I think the market's going to stay in balance. So I think the most it would do is just poke down there and then reverse back up. But let's just say, hypothetically, it were to get down there and get some new selling, would be very, very bearish. Okay. Because again, now we're back to talking about the market as a swing trader. And we're recognizing that we've been bringing in buyers and defending this area for a while now. Okay. The market ran out of steam here to the upside and had to spend a whole day going sideways to bring in the momentum to continue the move here. We defended it here and here. So if we start to get down there and get new selling, it means the market needs a larger pullback. So again, resistance at yesterday's low is bearish, looking to test that balance area low at 62.60. New selling there, very, very bearish, and could liquidate the market much lower. If you put a gun to my head right now and you said, Charles, we still got 15 minutes before the market opens, you know, with the information that you have right now, what do you think is the most likely thing to happen today? My guess is the market opens, it pushes above 62.86 and it fails. Okay. So it does not find support there. Comes down here to this area around 62.70. It bounces and it kind of spends some time bouncing around in here. And then it comes down and it breaks these lows, getting below that overnight low at 62.60. Then it comes back up. That is the sort of day that I see here, a balancing day. So a day where the market tries to go higher. If it can't, comes down, spends some time getting people long, getting people short, getting people long, getting people short, breaks lower, cleans up all the weakness. And then it says, yep, that's all we needed. We just wanted to take out those stops. And then it comes right back up again. That is sort of the day. Now, obviously, I am not Nostradamus. I cannot predict for sure what is going to happen today. But if the information aligns with each one of those things, I will know how to trade. I will know that if the market cannot get above or cannot hold the overnight high, it's likely to come back for the low. I would know resistance there is sellable. I would know I want to take profits quickly because we may not get that full move right at once. We may spend some time grinding in here. I know if we do start grinding, I want to be looking for resistance to enter another short. That might be, again, the previous day's low. It might be this node right here just above around 62.83. We have to wait and see what's happening live as the market is trading. But I would know I could get short again for that move down to repair those weak references. And I know, again, I would want to lock in profits on a short down here at 62.60 rather than assume it's going to keep going, because even if it is going to keep going, it's going to go much, much further. So I don't need to be in the move the whole way. I can lock in profits, wait to see, and if it keeps selling, I can enter another short. Because if the balance area low cannot hold, the market is going to make a big move to the downside, both intraday and, over the next few days. So I don't need to force trades. Okay. I can wait and be patient on entering trades. I don't need to fall in love with these trades. I can take profits quickly. I can move my stop below my entry. I can be like water. I can change my mind as soon as the market generated information changes and adjust my strategy accordingly. Why? Because I know before the market opens that this is one of those days. That this is one of those days where it's going to look like something is happening, and then all of a sudden out of nowhere, the opposite is going to happen. I'm prepared for that psychologically. So I have to include that in my strategy. And that's how I'm seeing the markets. Any questions on any of that from the chat? If you are watching this in the Discord, you can head on over to the Futures-Charles tab, and you can leave your questions there, and I will get to them. Good morning to Trader inside there. Welcome, welcome. In the YouTube chat, we've got Rich. Good morning to you. DNK in the house. Welcome, welcome. Trevor is here. Sniper Trades, ahoy, matey. DNK says, it depends if we get below 45 to 50 area. If we do, then I think we could go down. Otherwise, we are in balance and heading back to the all-time high. So he's saying basically, if we can get below these overnight lows, he's looking for this area all the way down here. But if we can get down here and get new selling, the market will go much lower. But that otherwise, he thinks we're heading back up to the balance area high. I would say that's a little early to say. But I would be right there with you if this morning we start to get buying above 62.87. I would join that party real quick. The reason I have more caution, normally if the overnight were to look below and fail a balance area low, I would be bullish the next morning and thinking the market is going to go up to the balance area high. The reason I'm not today is, one, we still have 3 weak references down there, 2 of which are literally on top of each other. Okay. And that was a test of the balance area low, the way I have it drawn, to a tick. So that's very exact. And it's much better with balance areas if you look below and then fail and come back up rather than if you just touch it. So I'm a little more cautious thinking we're heading to the balance area high. But if this morning we get new buying, I'm going to change my mind real quick and get bullish. Lido in the house. He says, good morning. Is that Quant Tower on the left? Quant Tower has market profile. That is not the one I'm using. The one I'm using is called Window Trader. But you are right that is a market profile chart. So for those of you that don't know what you're looking at here on the screen, the left side of the screen is a market profile chart. This is a price action chart. So it's simply showing you the same things that the candlesticks show you. Where does the market go? But it shows you in 3 dimensions. It gives you a 3D view. So you get to see the areas not only where price went to, which is basically what a candlestick high and a candlestick low is, and what the wicks would be, which is basically like any area below the opening and above the closing, right? That's what a candlestick would show you. This is also showing you where the market spent the most time and where the market brought in the most volume. And so you get to see the market in 3D. And that's very, very important because every move the market makes is based on three ideas. First, price advertises. So the price goes to a new level to see if there's going to be business at that new level. Price doesn't know whether business is going to happen there or not, but it just goes there to find out. So for example, we've been talking about this overnight high right here around 62.86. That's a level that price might want to go to today. And it doesn't mean it's bullish, right? It doesn't mean it's bullish if the market goes up there. Because first, price just advertises. It just goes to that new level to see, hey, does anybody want to buy and sell some futures contracts here? And then if the market can spend time there, if it can stay up there, then you know that eventually people are going to do business, right? The more time that people are watching the market dance on a certain level, the more likely they are to trust that that support is going to hold or think that that support is going to break and choose to get long or short. So first, price advertises to a new level, then time regulates. Time decides, are we spending enough time here for people to do business, for people to go long or short? And then volume measures. So if you push up to that new level and all of a sudden you start bringing in volume there, that means the market is likely to keep going up. Because if you were bringing in more sellers, price would advertise lower. So if you push up and you stay up, you're bringing in more buyers than sellers. And so price is going to go up because there's buyers and it's going to look for more buyers at a higher price. Okay. So that is one huge advantage to market profile, is it lets you see the market in three dimensions to see where it is spending time and where it is bringing in volume, which is why I said this morning, yes, it would be bearish. If the market gets below Friday's low at 62.78, it would be bearish and increase the odds the market is going lower. But I would be cautious thinking it's going to go further than 62.70 because we spent a lot of time and brought in a lot of volume there over the weekend. So even if the market gets resistance and it starts to get bearish, people start to change their mind, they start shorting, it may just bounce right there. So that's something we want to be aware of. Where are those levels where there could be potential support or resistance? And maybe we blow right through it, but just knowing it's there is a little bit of an edge. Okay. It tells me to move my stop below my entry or lock in profits and look to re-enter because there's a potential for a bounce. Then over here on the right side of the screen, we have the Bookmap software. So Bookmap is basically showing us the order flow. So whereas Market Profile is showing us the actual contracts that have changed hands and where they actually changed hands, the Bookmap is showing us where they may potentially change hands in the future, right? So by looking at the order flow, we can see areas, this right part of the chart, on the right of this white line is the current order book. So this is where orders are currently sitting. So if you see orders above, those are shorts, right? Limit shorts that are sitting above price. If you see liquidity below, those are limit longs sitting there waiting to get filled. You can see it by looking at the color on this section right here. You can also see it by just looking at the current order book right here. That'll show you the exact number of contracts at the level. And then if you look at this SVP, I've got that set up to show the delta. So if there is a level where there are, a lot more contracts that have been going short or long at a particular level, you'll see that here. That is not the current order book. That is what has traded at those levels, the last time they were tested. Okay. So there have been longs up here at 62.91. There have been more longs. So if we were to get up there and fail and come back down, what's probably going to happen to all those longs? They're going to get squeezed and the market's going to pull back and so on and so forth. The other thing, and probably one of the most important things about Bookmap, is the stops and icebergs indicator. So that is these little symbols that you see popping up on the chart. This one right here is an iceberg. So if it's got the two little triangles like that, that is a sign of an iceberg. That just basically means that somebody is hiding the number of orders that they're going to fill at a particular time. So in this case, they only filled 30 contracts, but it may have been 300 for all we knew. So an iceberg is somebody hiding an order size. And a stop is when you see the little dot. And I just basically have the software set up so I'm only seeing when larger amounts of stops get taken out. So if a bunch of stops get taken out at one level, like 72 stops all at once, that's going to catch my attention. And by seeing where the stops are, I can often predict where the market might reverse, right? Often when the market is working its way up and it comes back down, right at the high, they will have taken out a huge number of stops. So this is all just relative. I can't give you an exact number and say, oh, if it's 200 stops, the market is going to reverse. Some days they can take out 200 and then 500 and then 800, and they can just keep going and going and going. So it's all relative to whatever the volume is on that particular day. But when you start to see the number of stops getting taken out on the way up is less and less and less, you're probably waiting for that one final big number, and then boom, it's going to reverse. So the icebergs let me know who is doing business. Somebody with larger size that's trying to hide those orders. Also day trading bots. The high frequency bots use icebergs. So I know it's one of those two. And then the stops let me know when the market might be running out of steam or that it still has steam. If you take out some stops and the market keeps going up, you know it's going to keep going up until it takes out even more stops. It's got to clean up the order book and take everyone out that it's going to take out first. Then it'll turn around and come back down. Okay, so this little move that we're getting right now as I am talking over the last couple minutes changes things quite a bit in terms of today's analysis. This is why I said today is a day you must be like water, my friends. This is one of those days. So I would now describe the chop zone as being a much bigger area at the market open. It'll be whatever is the overnight high, which currently is 62.91 to the previous day's low to 62.78. So that's a larger chop zone where the market might grind sideways. But this little move is actually bullish to see because it increases the odds that we got a test of the balance area low and that we're now heading to the balance area high. When we were just grinding around Friday's low, it was a lot more uncertain. This gives us a little more bullish sentiment. Okay, just a little bit more bullish. It also means the overnight inventory is completely net long. So what does that tell us? It tells us do not go long right away first thing this morning. If everyone from the overnight is long, then guess what's probably going to happen? Some of them are going to take profits and the market's going to come back down. And those that didn't take profits are going to get squeezed on the way back down. So there's a lot of buyers who have stepped in basically from the 62.60 level to where we are right now. And all those buyers will start to change their mind if the market goes down this morning. And that could lead to liquidations. So this is absolutely a chop zone. It's a little more bullish, but it's still a chop zone. Do not force trades first thing in the morning. Let the market bounce around. Let it advertise higher prices and wait to see if buyers step in there. Let it advertise lower prices and see if sellers step in there before you join the party. You don't have to be early until you have momentum one way or another. Then you don't want to wait around. Once you know, you got to go. Any questions on any of that from the chat? With the 1 minute we've left till the market open. Good morning to Crypto Rider, Will, Jarrett, Arjit. Lido says, love Bookmap. Just got it like a week ago. And still need to learn how to use it. I have been going in where I see support and resistance, and I guess I need to see the bigger picture. Yes. So the thing about order flow, right? The thing about trading, what's happening in the order book is that most of it is fake. Most of it is spoofing, particularly if you trade the ES or the NQ. It's a little more reliable on individual stocks. But if you're trading the ES or the NQ, most of the liquidity in the order books is fake. It's not really going to fill. There's an example of it right there. There was a bunch of sell orders right at 62.92. But look what happened. Let me zoom way in so you can see in a fraction of a second. Look at what happened. As price got up there, as the ask started to get there, they reduced that liquidity. They disappeared it so that those orders never actually filled, right? So if you were putting your, entry right there with your stop above it, thinking, oh, that's resistance. Well, no, they just go right through it. So the thing with order flow is it is unbelievably valuable, but it is just a tool for context, right? You need to understand what the probabilities are and then just use it as a second opinion. And I like to get those probabilities from the market profile chart because that gives me the most clarity in understanding what the market will do. All right, so we are in the chop zone. I would just call the chop zone the high they just made at 62.96. And the chop zone low is yesterday's low at 62.78. So if we get new buying above 96, it's bullish for continuation higher. If we fail, we're heading back down towards that low from Friday. Here we go. Let the party begin. So here is where we can start to look at the order flow to try to get an idea of what is happening. How do things change up here, right? Does liquidity suddenly appear or disappear? So boom, right now, liquidity just appeared at 62.95. So what does price do in reaction? Does it turn around and start to head up towards it? Well, great. Then it's acting as a magnet to pull price towards it. Does the price action push away? Well, then great. It's acting as a magnet to push away. Well, then whichever of those is happening, which right now it's the magnet to pull price to it, when it disappears, expect the opposite to happen. Same thing with this liquidity below. Right now, that is pushing the market away. If it were to disappear, expect the market to reverse and start coming down. Okay? So we watch these changes in order flow to see what the next move is. Is the market going to go up or down from where we are right now? And then we use the context of the market profile to figure out if we can trust that move. Will it keep going or will it just boop, go up there, the liquidity disappears, and then it comes right back down? You got it combined to have the context. Immediately, I'm seeing icebergs above and below price. That increases the odds they're going to chop around. They're going to be a little tricky here. They're trying to keep the market dancing around the opening price right now to get as many people long and as many people short as they can before they make a break one way or the other. Okay, so now they're looking for a pullback. We're in the chop zone. The next support is around 83. So the market is likely to dip down there and look for a bounce. I am not saying that just because there is liquidity there, that liquidity will probably disappear. But this is also an area where there was support and resistance in the overnight. Okay, or resistance, in the overnight. And oftentimes previous resistance becomes support. So they're looking for a dip down towards 83. If they get a bounce, they'll come right back up through the opening price. If they don't, they'll head down to test yesterday's low around 78. So now we're monitoring this liquidity up here. They've just been adding to it. which has been scaring price lower, and we're waiting to see if this will disappear. The liquidity down here disappears and the market flushes through it. It stays there. It's going to be a slow grind to get down. Slow grind. Take it easy. Slow grind. Something choppy. Good morning to Danny G, Willie T, Abstract Grooves, Street Salsa. He says, do you only trade breakouts? No, I trade everything. I trade balance. I trade breakouts. But the idea is I don't trade until I know what's happening. Okay? Does that make sense? So a lot of times for the first hour of the day, the only trade there is a look above or look below and fail of some sort of level. So we talked about this idea that price advertises, time regulates, and volume measures. So if I'm saying to myself, there's one of two things that can happen. Either the market is going to get above here and it's going to find support and keep going, or it's going to get above there, not find support and come back down. There's nothing for me to do until one of those two things happens, right? We either have to break out or fail to break out for me to be able to have a trade. And so as soon as I could teach my brain to stop caring about watching it go ba 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 for an hour and then wait for that moment where it truly breaks or fails to break, that's where the best opportunities are. So it might seem like I just only trade breakouts or failed breakouts, but that is not the case. I will trade any moment that I see a high probability setup. If I feel very, very confident the market is going to do something, I'll trade for any reason at any moment. But the question is, how can I really have confidence? How can I really be sure that I'm right and I'm not just guessing, right? I have to see the market generated information confirm to me that I'm right. Does that make sense? So you start with the analysis and what your personal prediction of what the market is going to do next. Great. You make your plan for how you would enter those trades. For entering trades, you need to have the confirmation from the market that you're right. You don't just enter the trade because you think it's going to go up or you think it's going to go down. You say, how would I know it's going to go up or down? What is the level where something could change, like new buying above the overnight high, that would then convince me that I'm right? And then you get long. And so maybe the market, let's say you got a chop zone like we do this morning. This is our chop zone right here. So maybe the market comes down to here and it finds support and then it goes straight up, all the way above yesterday's high, let's say. Well, people will say, Charles, you should have been buying the low. You saw a support level. You should have been going long. And I'll be saying, yes, but I would be guessing at that moment that the market is going to go higher. I wouldn't know for sure. So what I would rather do is do nothing inside the chop zone, wait for it to get above the chop zone high, wait for that support, then get long for the move up to the previous day's high. Okay. Now, in terms of actual points that I will make on the trade, obviously, I would make a lot more points if I entered down here and took profits up here than if I entered here and took profits up here, right? Obviously, this is a much bigger amount of points, but this is where traders don't seem to understand. that it is not about how many points I make off the trade. That is not what matters. It is about the win rate and how many of my trades are profitable. Okay? So I would much rather make, 15 points off of a trade with a very, very high probability of working than make 30 points off of a trade where I'm fucking guessing and I don't really know. That's what trading the auction process is all about. It's that first you come up with the concept of what you're looking for and then you wait to see it. Then you enter the trade. If you can do both those things, see what's potentially about to happen, recognize it happening in real time, then you will have way more winning trades, which is all that matters. All that matters is that your percentage of winning trades is more than your percentage of losing trades. And you're a profitable trader. That's all it is. It is just a matter of winning more often. Whereas most traders, what they're trying to do is they're trying to make as many points as they can make off of any given trade. And so they're kind of guessing, maybe it's going to go up. If I'm right, I'll make all these points. And so they go long or short as a guess. And that is what I do not do. Just too many years of losing money and feeling the pain for me to finally come to the realization that patience is my edge. Now, I'm not going to be patient in entering the trade once I know what the trade is, right? I'm going to get in the trade. The minute I have the statistical probabilities in my favor, I'm in the trade, because then it starts to go against me the longer I wait. The odds go against me. But until I know I have that statistical edge, the best thing to do is wait and watch and observe. Like I said, we are heading to 62.83. But because this liquidity is still here, it's going to be a choppy, slow grind to get there. We're not going to go in a straight line. So if I'd have gone short when I made that comment that we were heading down there, I may have just gotten stopped out just now, right? Which is why I have to take that into context. At this moment, boy, oh boy, whoops. Didn't it feel like, oh, God damn it. There we go. At this moment when we were down here, didn't it feel like it was going to head straight down? Oh my God, I got to get short. I'm going to miss it. But I knew as long as this is still here, it's going to be a choppy move lower. So of course they completely reverse. They take out all the sellers that were chasing price down. And then what do? Now they come down right to where we thought they were going to come. Okay. So now we're watching for support. Do we get a bounce here? This is real market generated information. If we get a bounce here, we can trust that the market will come back through the opening price and that will significantly increase the odds that we're heading up towards yesterday's highs. If we don't, we know we're heading for yesterday's low where we're looking for that potential breakout to the downside. Okay. And by the way, no support. So that is a sign we need to head to yesterday's low and see if we can break out of this chop zone. But my, oh my, doesn't it change fast, right? Didn't it feel in the first 5 minutes of the morning like this thing was going to break higher? And then out of nowhere, it came down. And then didn't it feel like the market was going to break lower? And then out of nowhere, it reversed and came back up. This is what they do in balance. In particular, when they're inside a chop zone, is they make it feel like one thing is going to happen. And then out of nowhere, they reverse and do the opposite. Because that is what gets the most liquidity to trade hands. By getting people long and stopping them out, they get you in 2 trades in one day. You fill the order to go long and you fill the order to get out of the long when you get stopped out. So by chopping and grinding and chopping and grinding, they can create more liquidity. They can get more contracts to change hands. And that is all the market cares about, is that as many contracts as possible change hands. So as I said, the next thing we're watching is for a test of Friday's low, 62.78. If we get below there, there is a potential for the market to break much lower if we turn that into resistance. If we get below there and we cannot turn it into resistance, we're going to turn right back around and head up for the opening price again. So can we get new selling below 78 or not? Let's find out. Also, if we do poke below Friday's low, this iceberg being here increases the odds that it will look below and fail. This increases the odds that it will come back up into Friday's range because the market knows there's liquidity there. Okay. So the market loves to go where the liquidity will flow. You know? St. George says, we need a I Love Charles merch. That's the first request I've ever got for that. I'll make a shirt that says I Love Charles, but somebody better buy it if I make it. Okay, so now in terms of resistance, potential resistance levels, I'm watching the halfback. Why? Because we know the market wants to come down here and test Friday's low. That's what it wants to do now. So it's looking for a place to bring in those sellers to get down there. We've got two levels right here that we call low volume nodes, where there's less than 200 contracts that have traded intraday. So those are a magnet on price. They just disappeared that iceberg. So that increases the odds that this halfback will hold as resistance. They come back up, they backfill those low volume nodes, they find resistance at the halfback, and then they head down to test Friday's low. Okay, so there's the backfilling. Those are backfilled. Now we're watching for resistance at 88. If we don't get it, it means more chop, more sideways, more grind. If we do get it, the test of Friday's low. Right here, right now. To resist or not to resist? That is the question. Okay, so the chop continues. So again, we got to be like water. We got to be like water. We got to be like water. We got to constantly change. Now the market is saying more sideways, more chop, more grind, which increases the odds of a look above and fail that will come back down once again. At this point, to me, a look above and fail of the opening price is tradable for a short. So if the market gets above the opening price and it cannot turn that into support and keep going, it is likely to turn around and slingshot lower. Because every indication is telling us they want to keep on chopping. Okay, so passing through the opening price is a little bit bullish, but now they got to turn it into support. They got to stay above 62.94. If they go up and then come back down through it, it's going to lead to a move lower. So can they stay above the opening price? No, they cannot. The chop continues. They keep chopping, always chopping. Bulldog in the Discord says, how do you determine what is new buying and new selling? It's a great question. So the idea is simply, how did the market get to a certain level? If it gets to a certain level and gets above it or below it, if it can stay there, it's new buying or selling. So right now, no matter what liquidity takes place above the opening price, for the market to stay above the opening price, there has to be more buyers, right? If suddenly somebody came in with more shorts than longs right now, what would the market do? Price would move down, right? So for it to stay above that opening price, it has to be more buyers. And so that's what I'm seeing, or that's what I'm watching for. Do we stay above there? And the longer we stay, the more and more and more buyers that we're bringing in. And at some point, the sellers who are shorting will give up, and then you get short covering. Okay? So you're just watching to see, once you get above a certain level, can it stay above there or not? How you decide these levels is a whole nother conversation that takes a while to explain, but it's opening prices, closing prices, like a closing price of the previous day. It is an overnight high, an overnight low, a previous day's high, a previous day's low. Once the market starts to trend a certain direction, so if it starts to go higher for a couple of hours, the previous 30 minutes candles high or low is often a level to watch for these changes. But the long and the short of it is, new buying means they can stay above that level. New selling means they can stay below that level once they get there. It's also just what you would call support or resistance. So when they get above the opening price, can they turn that into support? When they get, below the opening price, do they turn that into resistance? That sort of thing. Okay, so the look above and fail of the opening price increases the odds we're coming back to the halfback, which is now at 62.89. Same as we did before, we will watch and see, can that become support? If it can become support, we're taking another poke at the highs. If it cannot, the chop will continue until morale improves. It's so choppy, very choppy. They are squeezing the short-term traders on both sides. Make Wave says, Charles, is it true that the market reacts to the big orders? Yes, it is true. So a lot of the liquidity in the ES is short-term, high-frequency traders. Okay, they're computers, basically. They're not humans. And what those computers are doing is every minute, every second, every millisecond of the day, they are calculating where the liquidity is in the order book. So if we were to zoom way in and look at it on like a millisecond level, you can see that orders are constantly changing. You see all these little dots appearing and disappearing in here? Do you see how the color is getting like darker orange, lighter orange, darker orange, lighter orange, red, yellow? You see how it's changing? These are in a fraction of a second. That's those high frequency bots. Okay. And so what they are doing all day, every day is they are measuring where the liquidity is. And then they are trading based on, their algorithm, however it's programmed to trade. As those liquidity levels change, the programming changes. The computer in a millisecond decides, I'm going to get out of this trade, I'm going to enter this trade, I'm going to adjust this, I'm going to do that, whatever their system is. The funny thing is, these high frequency traders, they are not complex systems. They are very, very simple in terms of when they choose to go long, where they choose to take profits, and so on and so forth. But it happens in milliseconds. It happens so fast that the human eye can't even track these changes. But a computer can. A computer can keep track second by second of every single change that happens in liquidity. So one way, because remember, a lot of retail traders have this misconception. I got to turn on my air conditioner. I'm starting to sweat in here. It's getting hot in here, and you don't want me to take off my shirt. So one of the ways that, it's not really the big boys versus retail. We don't even have enough liquidity for them to care. We're just fodder in the middle of the battle between bigger players trading one another. So one of the ways that bigger players will trick one another is by putting liquidity in the order books. They'll put in a big order somewhere, and because that throws off all the other day trading bots that are now adjusting based on the fact that that liquidity has changed. But the company that put that liquidity there, they know nothing has changed. So they can take advantage of tricking the other people. Now, will those orders actually fill when the market gets there? No, of course not. They'll probably spoof. They'll disappear right at the last second because they were never really going to get short at that level. They were just trying to trick the other bots. So here we are. We are now testing the halfback right here at 62.89. As I said, if we get a bounce, we look to come back up through the opening price. If it does not bounce, it means they're going to keep playing this game, that they're not done. They're going to keep chopping and grinding and chopping and grinding. So can they hold the halfback? This was the first test right here. So far, it's holding. Streets also says, it seems like the chop will trend and then a sharp move will reverse against you. Yes, that is what a chop zone is. It's that it looks like something is happening. It looks like the market is building momentum and then it reverses. That's what it does. What's another way to explain this? It's like the market isn't actually planning to go anywhere. You know what I'm saying? Like, not that this is true, but I'm just saying, like, pretend that there's like a man that secretly runs the market. It's like he decided at the open this morning, we were just going to keep coming back to the opening price. But he takes it down to get you short. He brings it back up to get you long. He brings it back down to squeeze your longs. That chopping mechanism of just randomly reversing over and over and over again, that's what gets the orders to change hands. The market really has no intention of going anywhere, which is why we so obsessively draw these chop zones so that we can understand where those changes might take place and enter trades. Because as long as they keep chopping, they're going to keep chopping. There's an expression that Jim Dalton uses: traders will do what works until it doesn't. So far this morning, making it look like they were going to break higher is getting people long. Coming back down is squeezing those longs. It's working. So they've done it twice now. Right? Guess what they're about to do at the lows once again? They're going to poke back down, make it look like the market's going to go lower, and then they'll reverse it back up again because it's been working so far, so they'll keep doing it. And it's when something changes, when you finally get that new buying or that new selling, that then they have to start doing something else. They have to start trending instead of chopping. I know it sounds complicated, but just stick with it. Watch it every day and watch it through this lens. Tell yourself this in the morning. If the market opened inside the previous day's range, probably the market is going to go sideways for a while. probably it's going to squeeze people on both directions. So where are those levels where it could change, where it could break? Draw them on your chart. Draw an actual box and say, this is my chop zone high, this is my chop zone low, and watch what happens when it gets above. Watch what happens when it gets below. And you will see, if you don't get resistance or support, it comes right back in. And the more you train your brain to look at the market through this lens, the more sense it will make. The less you will care about the scalpers that are bragging about, oh, I made 10 points from here to here or whatever, because you'll realize they were gambling. They got lucky. That's all it is. Every trade in the chop zone is pure and utter luck. It either works or it doesn't, and you have no edge, no control over whether or not it will work. That's what makes a chop zone. And sometimes the market can be a real douche and just keep chopping and grinding and chopping and grinding and chopping and grinding. Okay, so now we're looking for the market to head down to the previous day's low. And you say to me, but Charles, you said that like 20 minutes ago. You said we were going to head down for the previous day's low, but we were still inside the chop zone. So that gives us the context of knowing it can reverse anywhere. So we are heading for 62.78, but it could reverse anywhere. As long as we are below the opening price, the highest probability as of now is that we will get to 62.78. They tried to take the market higher and they couldn't. Now they need to try to take the market lower and find out if they can. This is the way the probabilities play out. Now they may go sideways in here for an hour before they do it. I can't time it, but I'm telling you, if they could not get new buying up here, the next thing to try out is new selling down here. And so that is the way I see the market as of now. Unfortunately, I must say goodbye, farewell to all of you, and go hang out with the cool kids in the Pirate Traders Brigade. If you are not a member of the Brigade, what the heck is stopping you? You can see the link at the top of the page, piratetraders.io/join. It costs $20, and I assure you that if you trade the ES, you will make back your money tenfold. Okay, $20 is less than 2 ticks on the ES. So I guarantee you over the next month, I will say something that will help you get in a trade where you could win 2 ticks, or stop you from getting in a trade where you would lose 2 ticks, and then the Brigade membership pays for itself. So if you're not a member of the Brigade, you should absolutely consider joining. Check it out. You can cancel anytime you want. And we have a great community of people that have been trading with me for years, who understand this stuff and are very supportive of other traders. And we love having new people join because they ask great questions. So we like having a mix of both. The older experienced traders that can be supportive, and the newer traders that have great questions and can get us thinking about things and re-examining things all the time. So if you are not a member of the Brigade, we'd love to see you there. If you are a member of the Brigade, it's time to set sail. Thank you all so very much. If I missed any of your comments in the Discord, I will answer them individually. Otherwise, I will see you here next Monday morning. Have a great rest of your day and a great rest of your week, everyone. Okay, thanks.